Hi everyone, welcome to the Yes Investment Club. This is the third chapter of the Advanced Investing course, and this chapter will focus on the corporate actions. So you must have heard terms such as dividends, stock split, buyback of shares, but you have not clearly understood the meaning, right? So for a layman learning about investing for the first times, these terms might sound complex to understand, and this chapter clearly explains each term by telling the definition, giving an example, showing the formula, and more importantly, explaining the purpose of these corporate actions that are taking part in the stock market. So the syllabus for this chapter will be, first we'll discuss what are dividends, then move on to bonus issues, then talk about stock split, then right issues, and lastly we'll cover the buyback of shares. So let's first understand dividends, right? What are dividends, the formula, the situation, the dividend process, and the purpose. So the definition of a dividend is actually the amount of money that a company pays to its shareholders out of its profit to reward them, right? And a dividend is calculated on a per share basis, right? So how many ever shares you own, that much amount of dividend you will receive, right? So this diagram represents the example, the definition astutely. So company profits is a major triangle. Out of that, some amount of profit is given in the form of dividends, and the dividends are actually received by the shareholders as an additional profit to whatever they are earning, right? Um, so let's move on to the formula. The formula of the dividend is basically the total profit that is earned by a company on a yearly basis divided by the total number of shares owned by individual investors, right? Then now let's understand dividend through a situation. So for example, imagine company A has a profit of rupees 10,000 and it decides to distribute dividend because it has additional profit or it wants to develop trust and reward the investors. So assuming that there are 8,000 public shares that have been issued to the investors, the dividend will be rupees 1.25 per share. Why? Because we'll just do the total profit, which is rupees 10,000 divided by the total amount of outstanding shares that are being traded on the stock market, which is 8,000. So rupees 10,000 by 8,000 will give you rupees 1.25 per share, right? So indirectly, if you own 100 shares, you're gaining a profit or a earning of 125 rupees on those 100 shares because of only dividends, right? And this is not into account the stock fluctuations, right? If the price of the share is rupees 50 and it goes to 60, you will earn that amount of profit also of rupees 10, and as well as the dividend that the company is giving you. So let's try to understand how the dividend process works. It is a bit complex to understand, but we have broken down this into steps. So first, there is a dividend declaration date. So this is on this date, the company holds the AGM, which is the annual general meeting, which happens once in a year, and the company approves the issue of the dividends, right? So they discuss among the board of directors and tell that, okay, this year we will give, or this time of span we'll give dividends because we have extra profits and we want to reward the investors, right? Now, then the second step is ex-dividend date. So to get a dividend of a share, you need to own the share or have it in your portfolio before the dividend date is announced, right? So the ex-dividend date is typically before the record date, and this determines whether the buyer of the stock will be entitled to receive the upcoming dividend, right? So if you have that stock in the stock portfolio, it means you'll receive the dividend, right? And before this date, the stock has to be in your portfolio. Then comes the third step, which is the record date. So this is when the company decides to review all the shareholders that are registered and listed down to make a list of eligible shareholders for the dividend. And usually the difference between the dividend declaration date, which is the first step, and the record date is about 30 days, right? So you get about like 30 days of time to analyze the stock performance and to invest in it so that you can receive the dividend potentially, right? And the fourth step is the dividend payout date. This simply means that the date when the dividends are finally given to the eligible shareholders. And this also follows the process of the T+2, wherein the company releases dividends, and after 2 days, 2 business working days, the dividends will be received in your account, right? So moving on to the process of the dividends. So a company is actually not obliged to pay dividends. However, dividends are beneficial because it allows the investors to build trust on the company, because the company is going out of bounds and not using the profit for itself, but giving it to others or the shareholders, telling them, okay, thank you for investing in us and keep on doing so. And this evokes the process of like trust building, because the investors feel like, okay, the company is also caring about us and it trusts us as investors, so we should invest more.
Okay, so next we're going to talk about another corporate action, which is known as the bonus issues. So bonus issues, by definition, are free shares that the shareholders can receive against shares that they currently hold of that company. Remember that the important thing is that bonus issues do not change the total amount of investment you have made into the company. It just increases the amount of shares that you own for the same amount of money that you invested. These allotments typically come in fixed ratios such as 1-to-1, 2-to-1, or 3-to-1. And these ratios just mean that, for example, with 3-to-1, which is on the next slide, the example 3-to-1 is that you will receive 3 extra shares for every 1 share that you buy from the company. So let's move into a situation to better understand how these bonus issues work. For example, if the company has a bonus issue ratio of 2-to-1, the existing shareholders will get 2 additional shares for every 1 share that they hold at no additional cost to the investor themselves. So for example, if a shareholder holds 100 shares, they will be issued an additional 200 shares so that their total holding will go up 300 shares. However, what's important to remember is that when the bonus shares are issued to them, the number of shares that the shareholders have themselves will increase, like I said, from 100 to 300, but the actual investment's overall value will remain the same. So the company will only get the investment value for that initial 100 shares that the investor purchased. So you might be asking, what is the purpose for issuing bonus shares to investors? So bonus issues are the company's accumulated earnings, which are not given out in the form of dividends, but instead they choose to convert them into free shares to hand out to the investors. Companies issue bonus shares to, like similar to dividends, encourage investor participation and increase their equity base. So when the price per share of a company is quite high, it becomes difficult for new investors to buy shares of that particular company. Therefore, by handing out these bonus issues and bonus shares to the existing investors that are already invested in their company, the company is increasing the supply of shares going out to investors and therefore resulting in the price per share to reduce, thereby allowing new investors to buy the company's shares.
Now let's move on to a stock split. It's another type of corporate action given out by the company. It's kind of unique in this sense, which we will explore later on. And to do this, we'll use an example of a company, which I will come to. So before we begin with the example itself, let's first understand what a stock split is. So literally, as the name suggests, it's when the company divides the existing shares of its stock into new shares, though the total values of the share remains the same. So for this, let's just take an example. A company has 100 shares and each of them are worth rupees 10. Then it announces that it will be doing a 2:1 stock split. So what this essentially means is that shareholders get 2 shares for every share they hold. So let's assume that shareholder X owned 1 share of the company for 10 rupees. And once the company announces the split, he receives another share from the company, but the value of that share is 5 rupees. And the value of his original share is also 5 rupees. So what's essentially happening is he doubled the total number of shares that he had, but the value of each of the shares halves, or according to the split given, it changes. So after the stock split, the company will likely have 200 issued shares at a value of 5 rupees each. And so the company managed a 1:2 stock split while keeping the same market capitalization, because 100 shares at 10 rupees and 200 shares at 5 rupees have the same value. All it has done is just simply doubled the number of shares that investors are holding. So now let's move on to the purpose. So the main purpose for companies to do so is to split their shares so that they can lower the trading price of the stock to attract more investors and increase liquidity of the shares. So what this basically means is that if the price is lower, it's likely that people who are more willing to or more able to buy the shares will go to buy the shares because it's cheaper, and they can then buy more of the shares of the company as well. On top of that, when we mean it becomes more liquid, it also means that it's much easier to convert to ready cash, because what's happening is, rather than having one share that has to be converted, you can have multiple shares that can simply be grouped up, and then you can convert it back into money if you need. And so it's easier for the company as well as the investors in the stock split. So there could be a bit of confusion here for what's the difference between a stock split and a bonus issue. So just keep in mind that a bonus issue basically offers an additional free share apart from the existing shareholding. So like Ishan explained, the point of a bonus issue is essentially that they earn a completely different share. It does not change the value of the pre-existing share, but it's just that they get a different share with the same amount of value. But a stock split, on the other hand, basically halves or quadruples the amount of the value of the share, simply because the company is offering you another share, but in return, it halves the price, or depending on how the stock ratio is issued, it will change the price. So that's the main difference you can keep in mind. I think the best way you could look at it is through this diagram. What's happening is the blue share in the stock split has turned into two different shares, whereas the blue share in the bonus issue has turned into two entirely different shares that, when added up, give a very different value.
Right, and so now we'll be moving on to right issues, and so we'll be talking about what exactly is it. We'll talk about the Fitz ratio, as all the other types have done, and an example and its purpose, and another comparison. So what is a rights issue? So a rights issue is an invitation to existing shareholders to purchase additional new shares in the company at a price lower than the actual market price. And so like the other types, it also has a fixed ratio. And so, for example, if you have a 2-to-5 ratio, you would read it as that you can buy 2 new shares for every 5 shares that a person holds. And so, for example, if an investor is trading at a share at rupees 10 each, and the company announces a 2-to-5 rights issue, and so this means that each investor can buy 2 new shares for every 5 shares that a person holds. And so, however, to entice the investors, the company announces a discounted price for each share of 6 rupees. And so this means that for every 5 shares at 10 rupees each, the company will offer 2 shares at the discounted price of rupees 6. And so here you can see that each share is worth the price of 10 rupees, and this person has 5, and so this total value is 50 rupees. And additionally, they're able to get this rights issue, which each share is at the value of 6 rupees, and they have 2 of them, so the total value of the rights issue is at 12 rupees. And so the main purpose of the existence of the issue is that issues help raise fresh capital into the company, which can be used to improve its operations. And so, however, instead of going public, the company can approach its existing shareholders. And so, and you can think of it as like the rights issue as kind of like a second IPO, so the second initial public offering. The main difference between is that you have to pay money in order to acquire new shares. But bonus issues, you're just getting the shares for free because you are already holding some of the shares already. And so hence the shareholder should only subscribe only if they are completely convinced about the company's future, because you're actually paying money in order to gain that new share. And so you can see that for rights issue, you're paying money in order to get that additional share, and bonus issue, you're just getting that new additional share.
Great. Now let's start with the understanding of the fifth corporate action, which is the buyback of shares, and we'll understand what is it, the situation, and the purpose of a buyback share. So basically, the definition is when a company buys back its shares from the existing shareholders, usually at a price that is higher than the market price, is known to be the buyback of shares, and the name says it all. So let's understand it with the situation. So, for example, company A has made a profit of rupees 1,000, and it has a total amount of outstanding shares that are being traded of 100, right? So the earning per share will be rupees 10, because the profit will be divided by the number of shares, which is 1,000 divided by 100, which is rupees 10. Now the company decides to buy back 50 of its issued shares from the shareholders at a price that is higher than the market, may it be 10% or 20%, right? So this makes the total number of issued shares at 50, because what it is doing is, there were initially 100 number of shares being traded. Now the company wants 50. That's why the company will get 50, and the remaining 50 will still remain in the market, right? But through this action, the essential part is, the earning per share has increased. Why? Because now it is, the profit is being divided by the number of shares, but the number of shares being actually traded in the market is 50. So it'll be rupees 1,000, which is the profit, divided by 50 shares that are running in the market, which is rupees 20. So as you can see, the earning per share for the remaining shareholders has increased from rupees 10 to rupees 20, and this means that the shareholder will get more profit, and the share price will potentially be repriced at a higher value in the future, because you can understand through this as a law of demand and supply, because the demand is more and the supply is now decreased, which will increase the price, and the increase in the value of the price will result the stockholder to share it at a higher price than what he bought it at, and he can earn more profit. So let's move on to the purpose. So the purpose of the buyback of shares is that it allows the companies to invest in themselves. So by reducing the number of shares that are outstanding in the market, the buyback of shares increases the proportion of shares that a company owns, and the buyback reduces the number of shares that are available in the market. This results into an increase in the value of the stock, because, as I explained earlier, the demand will be high, but the supply is low. That's why the price will go up, and that's why the buyback of shares is actually seen as a corporate restructuring method, because the company is actually restructuring it by buying its shares again, and then potentially it happens that it will release its shares again to the market once the company has restructured itself. So when a company actually announces a buyback, it signals that a company is confident in itself rather than it not showing courage, because the buyback of shares is actually saying that the company wants more profit to be earned. That's why it's reserving its shares for itself, and the private owners who are there, or the board of directors, or the founders who are there, will actually earn more profit because of the buyback of shares. And it is usually considered as a positive move, because the share price has increased in the market, as well as the private shareholders of the company, or the founders, have received more equity of the company itself. So that's all. Thank you so much.